So I'm not too sure if it's just me, but have you also started feeling a little tad bit uncomfortable with the level of bullishness and excitement in the US stock market today? So the stories are beautiful, the charts are going vertical, and the cheerleading is the loudest in some parts of the market, powered by the future. And if you ask some of these investors investing into this future and ask them what they're actually talking about, to them, it doesn't matter because the stocks in that particular category only goes up. So I stumbled upon this term investors are recently using, the $0 club. So before I show you, drop a guess in the comment section down below. What do you think this term actually means? So long story short, it's a list of multi-billion dollar enterprises with less than 10 million in revenue or some even close to zero. Yet, many of them are up triple digits on a year-to-date basis. And this clearly reminds me of that meme of us throwing the intelligent investor book into the trash can. So, you might then ask, what should we do now? If you're still paying fees for your trading and investing in 2025, come on, you're leaving money on the table. So Longbridge Singapore is changing the game for you. First, if you sign up today, you get to enjoy lifetime $0 commission on US, Hong Kong, and even Singapore stocks. Second, you receive an exclusive 12% interest boost coupon for 90 days on deposits up to 2,000 Singapore dollars, plus an additional 18 Singapore dollars worth of cash coupon if you use my link below. And if you're aiming for additional stock rewards, the rules are pretty simple. Open the account, deposit, complete buy trades within the guidelines, and hold your funds. So on the first tier, you have to keep 2,000 Singapore dollars for 30 days and to make 3 subsequent buy trades. You then get to enjoy $40 worth of Nvidia shares and $40 of Apple shares. On the second tier, you deposit 10,000 Singapore dollars and maintain it for 90 days. 5 buy trades, you get $135 worth of Nvidia plus Apple. And on the last tier, tier number 3, deposit 100,000 Singapore dollars, keep it for 90 days, do 8 buy trades, and enjoy $385 worth of Nvidia plus Apple shares. So the rewards are not stackable, so pick your level and execute accordingly. And this special welcome offer is for new Longbridge Singapore users, and it is valid until the 31st of October 2025. And with this in mind, for my Singapore viewers, please go and grab your rewards today. And thank you Longbridge for sponsoring this video. And I've also recently came across this newsletter discussing this exact phenomenon. And this was his conclusion, and I quote, "This might be one of the clearest signs we are in the late stages of a bull run. And when stocks with little to no fundamentals are trading like high-growth blue-chip stocks, it often reflects a market chasing dreams and not discipline," unquote. And of course, as a curious investor myself, I went down that rabbit hole, hoping to just answer this question. Are we really in a late stage bull market cycle? And of course, with the help of the greatest inventions of our time, I've kickstarted the discussion with our trusty large language model and told him, sorry, I shouldn't be labeling its gender. I've told it to come up with the best arguments. And here is their top 5. First, valuations are in danger zone compared to its history. Second, leadership is narrow and concentration is extreme. Third, there seems to be late-stage macro signals with growth some sort softening. Fourth, households are essentially all in. And fifth, leverage and speculative activities are running hot. So let's go through these different factors one by one. So when looking at broad-based market valuations today, I think it is fairly obvious, especially for those of you that are plugged into the markets. Nobody is arguing that the stock market is dirt cheap today. So the forward PE of the S&P 500 is over 23 times, whilst the 30-year average is only closer to 17x, suggesting a potential 35% premium. And across the board, regardless of which metric you use, the Shiller-Cape ratio, dividend yield, equity risk premium, all of them actually echo the same story. The market is not cheap. And the other time that we have seen such overextension is right before the dot-com bubble that popped before the 2000s. And henceforth, why the recent commotion and comparisons, and some even shouting the warning signals about history repeating itself. The second point, the level of concentration that we are now seeing today. So I've came across this deck from Apollo Global Management. So the argument is simple. The S&P 500 market cap concentration is pretty extreme. Drawing reference again to the dot-com era, the market returns concentration is extreme, the earnings concentration itself is extreme, and the CAPEX, capital expenditure concentration is extreme. And long story short, everything is extreme. And the only thing that is not extreme is the YouTube like button, of course. So please feel free to press your way up. And for those of you wondering who Apollo is, they are essentially an asset management firm with over 800 billion US dollars invested in alternative assets compared to your publicly listed S&P 500. And hopefully by now, you know where their interest is aligned without me spelling it out. Moving on to the third point, there are also some late-stage macro signals, which include the leading economic index being in a downtrend, and some indicators of so-called manufacturing and services stalling or even just outright contracting, suggesting that potentially the best times might be behind us. The fourth point, we've also seen US households and pension funds' equity share of their asset near or around record high. And the consideration here is that when everyone's assets or disposable assets are already in the stock market, there really isn't new funds or incremental buyers to support this next leg of the rally. And on the last point, we are also seeing speculative activities like trading 0-day to expiry options, clocking in record activities, the FINRA margin debt surging to new highs, and just general activities of speculations that we have seen at the start of the video with the $0 club. So the natural question is, how now, brown cow? Is the stock market crash really imminent? And should we just sell and hoard cash today in anticipation of lower asset prices? And truth be told, I can't tell you for sure whether you should sell today or not. But what I can tell you is that you wouldn't want to miss out on receiving weekly emails from me as I share my latest thoughts and musings of the stock markets. And you can sign up using the Substack link below. Now, let's go back to addressing all the different talking points from ChatGPT arguing for a bull market peak or the end of a bull market cycle. So I know this valuation talking point has been a top of mind concern for many investors, myself included, and I personally think the best response I've came across thus far is a short commentary from Howard Marks. And here's what he has to say.
Are we in that moment?
There's enthusiasm. There are high valuations. I don't know enough about tech stocks or stocks in general or AI specifically to know whether the valuations are excessive. My response to date has been valuations are not crazy. High, but not crazy. When things are either high or low, but not crazy, you can't make an observation that has a high likelihood of being correct.
Everyone recognizes that the market is on the more expensive side, but to say that it's a bubble waiting to pop might be a stretch because this rally has been sustained by extremely strong fundamentals, at least for now, unless it starts to take a turn. So we are still expecting a baseline 11% earnings per share growth for the calendar year of 2025, and the forward estimates of future earnings growth has also continued to rise. So as long as bottom line earnings of many of these companies remain extremely resilient, investors will continue to invest. And the $1 trillion question is, of course, will it turn for the worse? And if so, when? Moving on to the point being put forth by Apollo Global, suggesting an extreme market concentration of market cap, market returns, and the earnings of the S&P 500, I found this entire argument pretty interesting at best. So if the top few companies in the index are the strongest, the most profitable, and the highest quality, then what exactly is the problem of this concentration? So isn't that the essence of capitalism? To reward the best and to eliminate the weak? I would be far more concerned if the valuations continue to climb on a broad-based level and the rally is quote-unquote more spreaded out, but we are rewarding in the meantime the weaker companies and just plainly ignoring their earnings contribution to the general index. Moving on to macro signals. So on this point, like using GDP, ISM manufacturing indicators, so on and so forth, I think they can be good indicators to monitor the health of the real economy. But to use them as signals of some sort to predict stock market movements in the future might prove to be a little bit more challenging. And it's not necessarily a hill that I wish to die on. On the point about US households and the pensions' share of assets in the stock market, I'm not too sure if that relationship is conclusive to quote-unquote identify the top. And let's not forget that the US equity markets has already gone global, and the support for valuations might not just involve the locals' balance sheet per se. And truth be told, out of all the arguments that were put forth today, I'm personally most worried about this rise of speculative activities. So I don't look at it as some sort of objective benchmark, like when speculative activities reach this certain number, means that you should start selling down. But more so, it's just a general vibe check of some sort to understand how excited or euphoric investors are getting. And the funny thing is, we've just seen this exact scene played out not too long ago, back in 2021. And it seems like the speculative fever is back and running and everyone is on board. So people clearly don't learn the lessons, and we can only play along since we can't control the markets. And if you're to ask me, what stage are we currently in? Is there still more room to run? The short answer is nobody knows. But let's also not mistake that markets being rich doesn't mean that an imminent crash is coming. And as they say, markets can remain irrational far longer than you can stay sovereign. And more people tend to lose much more money anticipating a crash than in the crash itself. And let's not forget, there are still many tailwinds the market is expecting. Strong earnings growth, unlocking massive productivity gains, early stage of the AI investment cycle, suggesting ample runway for growth, a dovish macro environment, to name a few. And so for me, I'll be staying away from the list of companies in the $0 club, mostly supported by exciting narratives, particularly in the rare earths, nuclear energy, quantum computing, space satellites, just to name a few. So given this renewed optimism in story stocks and the general investment climate, I would like to iterate the value of prudency, which is far more important in such an environment compared to normal times, and to really step back, hold back the innate greediness and jealousy when it comes to comparing investment returns. And I think it could potentially be useful as well to remind yourself to stick to your long-term plan, tightening your investment criteria, and be much more thoughtful when deploying new capital into the markets today. So with that, feel free to leave in the comment section down below which part of the bull market cycle you think we are currently in, and I'll see you in the next video, but more importantly and hopefully, I'll see you guys on the moon. Goodbye.